There are different types of analysis. There are three main types that we will cover in this video, all of which will help you become a good trader. It is not good to focus on one in particular and let another one become weaker, as this could cost you in the long run. One type of analysis we'll be looking at is technical analysis, and what this basically is using historical price action and past trading activity, as well as technical indicators and other analytical tools in order to identify patterns and determine future price movements. Strategies involving technical analysis can be as simple as first identifying the trend, then identifying support and resistance levels, and buying when it goes into or near support levels, and selling when it goes near resistance levels. One of the most basic assumptions to do with technical analysis is that all known fundamental information out there is already priced into the current market price. And so if the price reflects all the information out there, then the only thing you would need to make a trade is price action. Another important assumption when it comes to technical analysis is that history tends to repeat itself. And so what this means is that if at a certain price it held as a major support or resistance level in the past, then in the future forex traders will look at this price and base their trades around it. With more and more forex traders using technical analysis, these price patterns and indicator signals tend to become self-fulfilling. But an important thing that you need to remember is that technical analysis is often very subjective, as two traders can both be right but draw two different support and resistance levels. The next type of analysis we'll be looking at is fundamental analysis. And fundamental analysis is a way of looking at the forex market by analyzing economic, social, and political factors that may affect currency prices. You have to understand why and how certain events, like an increase in the unemployment rate, affect a country's economy and monetary policy, which ultimately affects the level of demand for its currency. And this is the main difference between technical analysis and fundamental analysis. Whereas technical analysis involves looking through hundreds of charts constantly and identifying patterns or trends, fundamental analysis involves looking at economic data, reports, news headlines, and things like that. The main idea behind fundamental analysis is one key thing, and that is that if a country's current or future economic outlook looks good, then its currency should strengthen. If the better a shape a country's economy is, the more foreign businesses and investors will invest in that country, and this results in the need to purchase that country's currency to obtain those assets. Fundamental analysis can be broken down into three main fundamental indicators, the most important of which is inflation. Inflation shows you how healthy a currency's economy is. But what does inflation mean? Well, inflation is the sustained increase in the amount of currency in circulation. And what this does is it increases the prices of goods and services in the related economy. It is important to understand that even though the power of their central banks, governments do not have much control of their country's inflation rates. The two extremes of inflation are hyperinflation and negative inflation. Hyperinflation is where there's too much money being introduced into the economy. And when this happens, the currency will decrease in value since supply is bigger than demand. Conversely, if there's negative inflation where there's too little money being introduced, that means there'll be a larger demand for the currency than there is supply, which will lead to the currency increasing in value. Interest rates are another very important fundamental indicator. They are often used to regulate inflation. And interest rates are set by central banks, and they are a value charged by the central banks for lending money to private banks. And what private banks do is they charge you as a public for borrowing from them. So it's really important for central banks to notify the public of these changes in the interest rate. And this is usually done so in advance by press conferences. So what are the effects of the interest rates? Well, an increase in the interest rates is usually done so to cool down an economy by decreasing inflation. This cuts consumer spending, helping to bring growth to a more manageable level. And what this does is it forces a currency to increase in value, since there's a decrease in supply and an increase in demand. Conversely, when the government has to increase consumer spending and inflation, they decrease the interest rates, making it easier and cheaper for businesses and individuals to borrow money, which in turn decreases the currency's value, as there's now more supply than demand. Another very important fundamental indicator is GDP, which is gross domestic products, and this measures the total value of all goods and services produced in a country within a given period. And what does a growth in GDP show? Well, it shows that there's economic growth, and so this means that it's a better economy, meaning that the currency should increase in price. Another type of analysis is sentiment analysis. All information is out there and available to each trader, so in theory they should all act the same way, but obviously that doesn't happen. So what is making traders act differently? Well, it's their own personal preferences, opinions, and biases. Each trader's thoughts and opinions are expressed through whatever position they take, and this helps form the overall sentiment of the market regardless of what information is out there. The problem is that as retail traders, you can't move the whole forex markets by yourself. So if you want to open a trade, let's say the dollar to go up, you should make sure that everyone else is not going bearish, as if that's the case, you can't force it to go up, it's going to go down. And so it's up to you to gauge how the market is feeling, whether it's bullish or bearish. And then you have to decide how you want to incorporate your perception of market sentiment into your trading strategy. Most retail traders are wrong, though, so you could use this to your advantage, as the statistic for retail traders is that they lose money 90% of the times. So if you're simply to bet against them, you could have a higher chance of making money. You should also see how the market is feeling towards risk. If the market participants are more optimistic and are willing to take the risk, they may buy riskier currency pairs that could potentially generate them more reward. And the term for this is risk on, which means a higher potential yielding currency pairs will gather more demand from traders. And you can easily spot this when a currency pair is risk on is when the price changes significantly over a short period of time. Whereas when traders are feeling less optimistic and not willing to take the risk, they may buy less risky currency pairs, which will potentially generate them less reward, but may be a safer investment. And the term for this is risk off, which basically means a lower potential yielding currency pairs will gather more demand from traders. And a good indication of when a currency pair is risk off is when the price doesn't change significantly over a short period of time. Thank you for watching. I hope you enjoyed this video. Like and subscribe for more content like this, and I'll leave you guys once again with a quote. If you don't get serious about your money, you'll never have serious money.